This year's budget was one of the biggest we've seen for property investors in a long time. The headlines are making it sound like property investing is dead. But that's not what's actually happening. What is actually happening is the government are changing the way investors build wealth in Australia. And if these changes get legislated, this is going to completely reshape how investors buy property, what they buy, the structures they use, and who actually succeeds moving forward. So in this video, I want to break down all the changes to negative gearing, capital gains tax, the trust and bucket company changes, and what this all means for you as you look to invest and build wealth. Now, before we even get into the changes themselves, you need to understand why these changes are being put forward by the government. Australia is in the middle of a housing affordability crisis, a rental crisis, cost of living crisis, and massive pressure around housing supply. And politically, investors have become a very easy target. Because from the government's perspective, the argument is that if less investors receive tax benefits, maybe fewer investors compete against owner-occupiers. But the problem is, demand has never really been the core issue in Australia. Supply is. And the majority of these policies focus on reducing investor incentives without actually solving the supply issue. So let's jump into the changes and see what actual implications could be. Let's start with negative gearing. From July 2027, the proposal is that negative gearing benefits will largely only apply to newly built residential properties. Meaning from now, if you buy an established property, you won't be able to offset those losses against your personal taxable income. And this is massive because a lot of Australians don't realize how heavily negative gearing has influenced investor behavior over the years. Let's just say somebody earns $180,000 per year and their investment property loses $25,000 a year in interest, expenses, maintenance, and holding costs. Historically, they could offset that loss against their income and potentially save somewhere between $9,000 to $11,000 of tax each year. That tax benefit softened the pain of holding the negatively geared property. Under the proposed changes, that benefit disappears for established homes that you buy moving forward. So immediately, cash flow becomes way more important. And I think this changes investor psychology significantly because for years, a lot of investors were comfortable buying negatively geared properties purely for long-term growth. Now, investors will probably become much more focused on yield, cash flow, dual income properties, regional markets, commercial assets, and newly built stock, which under new changes is the only asset which can claim negative gearing moving forward. But the issue is that this could create some unintended problems. If investors step away from established property and fewer investors enter the market overall, where does rental supply come from? Australia already has extremely low rental vacancies. So if investors stop entering the market, we could end up with tighter rental supply and even higher rents long term. And ironically, the people who may feel this most is everyday Australians just trying to get ahead. The second major change is capital gains tax. Right now in Australia, if you hold an investment for more than 12 months, you receive a 50% CGT discount when you sell. Under the proposed changes, the 50% discount would effectively be replaced with an indexation-styled system with a minimum 30% tax on gains. The government argument is that this is fairer because inflation gets considered first. And this is where things get more complicated because accountants now potentially need to split gains across different time periods. For example, let's say somebody bought a property in 2022 for $700,000 and then sold it in 2028 for $1.05 million. That's a $350,000 gain. Under the proposed system, the gain could effectively be split across two periods: the growth before July 2027 and would still use the old 50% discount rules, while the growth after July 2027 would fall under the new indexation-styled rules. So hypothetically, around $250,000 of the gain falls under the old rules, meaning only $125,000 gets taxed at your personal marginal tax rate. And the $100,000 falls under the new rules, meaning it first gets indexed for inflation, and then the index gain is taxed at the minimum 30% rate, or potentially higher, depending on your personal tax position. So in this example, the total taxable gain might end up being about $190,000 overall. Whereas under the old system, if the $350,000 gain simply received the standard 50% CGT discount, only $175,000 would be taxable. The most controversial part of this is that it doesn't just impact property. This impacts shares and business sales. And this is why many business owners are up in arms, because if you sell your business and you're in the top tax bracket, Albo is taking 47% of the gain that you make. I think one of the biggest shifts we'll see is people more reluctant to sell assets and reducing the desire to build a business in Australia because selling just became more expensive. Now, this next section is especially important for business owners and could end up being one of the biggest changes in the entire budget: trust structures and bucket companies. So a common structure for the most part is family businesses may have a discretionary trust that owns their trading company. Now, if that trading company makes a profit and distributes that money, it needs to flow up through the trust before it goes out to either an individual as a dividend or potentially into a bucket company. But the change here is that if you distribute from your company via that trust, you're going to be taxed 30%. And then if you distribute into your bucket company, you're going to be taxed an additional 30%. The big change here is the franking credit that you used to get is gone. So you were essentially receiving double taxation on the money that you earned in the business and the money that you look to move into the bucket company to previously not have to distribute to yourself and pay the top marginal tax rate. Why are they doing this? It's because the government wants you to distribute that money to yourself and pay the top 47% tax rate if you are earning over $190,000 a year. This is where business owners are going to get hit the worst. You're essentially being forced to distribute to yourself and pay 47% tax if you're earning over $190,000 a year, as opposed to being able to sit that money into your bucket at a 30% tax rate and wait to invest in the future. Now, this isn't law yet, but let's just say it's a good time to chat to your accountant to get advice for you. And with this and the CGT changes, your accountant is going to be making a lot more money and they're going to have to work a lot harder for you moving forward. Now, what you shouldn't do is react emotionally right now. Personally, I bought 2 more properties within the last 2 weeks because I still believe in the long-term fundamentals of Australian property. But I absolutely think strategy matters now more than ever. The game is evolving. So if you're trying to work out how these changes impact your own situation in terms of investing and lending, there's a link below where you can reach out to the team and we can chat through what actually makes sense for you and your strategy moving forward.